Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
Hello and welcome to Property Investing Insights, Client Stories. Today's a bit different. I actually don't have a client here today. Instead, I have someone a client leans on when they're building wealth. And of course, when we are building wealth, we're looking at different people maintaining different roles and making sure that we're taking you through the journey. So we're talking, of course, about financial planning. And obviously that industry has changed over the years, where we've gone from a commission model to more of a fee-for-service model. And the reality is that the number of financial planners in Australia is actually decreasing, because this is one of the most strongly regulated industries in Australia. And I do hope that at some point in time we can say the same things about buyer's agents as well. So without much ado, I'd like to welcome Matt Ingram. Matt, you had to really battle traffic down the corridor to come across. Do tell us a bit about yourself.
Yeah. Well, obviously I work next door. I still managed to be a couple of minutes late to get here, so sorry for that.
Traffic was bad in the corridors, right?
It was. That was it, yeah. But yeah, look, we obviously know each other from working in the same building and worked together for a little while, but we're financial planners or financial advisors, interchangeable term. Yeah. And so we kind of cover the whole wealth management space, covers a lot of things, which I'm sure we'll get into. And yeah, I'm a partner there. There's 4 of us that run the business. It's North Haven Financial Management.
Okay. And so obviously I should have really introduced you as Matthew Ingram, licensed to plan, right? So
I guess so. That sounds pretty cool.
That sounds cool, doesn't it?
Yeah.
I'm going to drop the bombshell. You were an engineer before you became a financial planner. So there has to be a backstory here. So do tell us the backstory.
Yeah. Oh, it's not a crazy story. It's not too exciting. But I, out of school, went into engineering. Came from a bloodline of engineers. It only made sense that I would be an engineer. And so finished school, didn't really know what I was doing. Only picked civil engineering because it really was as simple as I got a scholarship to do it. So I went off and did it. As I was going through the degree, I worked in various roles, mostly in rail projects. So a few of the more exciting ones were the Northwest Metro.
Okay.
So the metro through this area.
So you worked on the planning stages of that?
Yeah. So the whole viaduct, the sort of bridge outside Rouse Hill, where the metro runs above ground. Part of the design and planning around that.
Right.
And then the Parramatta Light Rail was the next project I went on. And then from there I had a little bit of a pivot into coastal protection. So I worked on the Central Coast. And that was a nice change. It was building seawalls. So I spent a lot of time on the beach and on the waterfront.
Hard life.
It was a good job. But then I was kind of between jobs and bouncing around thinking, what comes next? What am I doing? And I bumped into an old church friend who had been running a financial planning business for 20 plus years. And I hadn't seen him for a few years. And so we were catching up, just chatting. A few days later, he made contact and said, why don't you come in for a chat? Went in for a chat, and the rest is history. I went off and did my master's in financial planning. Kind of started.
Which I understand that you passed with distinction, right? So.
I can't actually remember now. Is distinction, high distinction? I don't know. I can't remember. But yes, it all went pretty well.
Yes.
And like obviously working full time throughout it. I've got a couple of kids. It was a very busy period of life. But yeah, got through it, learned from the ground up, ended up buying into the business with that same church friend. And there's 4 of us that run the business together today.
So take me through. Let's say I've never met a financial planner, right? Tell me what a financial planner does.
Okay.
And then I'm going to ask you, the next question is, when someone's really got a good portfolio, what's the role of a financial planner at that point in time, right? So let's say I've never been introduced to a financial planner, don't even know that world exists. What does a financial planner do?
Okay, it's a big question. So I'll do my best to make it simple. Look, I kind of see financial planning as the oversight over all parts of the strategy. So you have amazing professionals working in different spaces. You have accountants, you have buyer's agents, You have mortgage brokers, you have solicitors, and they're all doing particular things as part of someone's strategy. The financial planner kind of oversees the big picture, gets to know the person they're working with really well, so that they can help piece together every part of that and make sure it's all running smoothly. So that covers things like, or maybe the easiest way to explain it is, if someone comes to me for financial planning, the things that I'm thinking about is, okay, what's the investment strategy? And that includes property and shares. Obviously, if it's property, we're relying on professionals such as yourself to assist. If it is shares, then we are helping to build that. That's more our bread and butter, share portfolios. We're looking at things like tax planning. So anything that we do, how does it fit in from a tax perspective? We are looking at cash flow. So again, when you're investing in property or shares, or you're going through life stages that maybe having kids, it changes your cash flow, trying to get that piece right. We're looking at estate planning, and we're looking at insurances. So things like life insurance, income protection, it's all well and good building the wealth, but you've got to protect it as well. So there's a lot that goes into it.
Okay, so it's more like wealth management than anything else, right? With planning. So when you're sitting down in front of a client, what's your process in terms of, okay, do you just start sprouting? And I'm asking this because this is what the general feedback is when people aren't introduced to financial planners early in the piece, right? So you don't start then talking products straight away. In fact, that's probably the last thing, isn't it?
Yeah. Look, there's definitely a perception around that. It's because financial planning used to be sort of the Wild West. In that there were a lot of advisors out there pushing people into products to get a commission. There was the Royal Commission several years ago, as well as other sort of reviews and inquiries throughout the years that basically made it what you said before, one of the most heavily regulated industries. There's a lot of red tape, a lot of things we have to do to ensure that good advice is being given. We're bound by best interest duty anyway. So now what it looks like is I have several meetings with someone to get to know them properly, to really get into their world, both personally and financially. It then leads into creating a holistic financial plan. And then it's about identifying products that are going to fit appropriately into that plan. But most of what we do is fee for service. It's not that we're getting kickbacks and commissions from placing people in different products. It really is, you're paying for our service. And so hopefully, people see throughout that process that their best interests are at heart.
And I guess it's a very hard profession for someone from the external looking in, right? Because if I look at it, I've got a tangible product in this app. We're buying bricks and mortar, right? A mortgage broker's got a tangible product where you're actually taking out a loan, and an accountant's got a tangible product where you're doing the tax returns and the business planning and so forth, right? Yours is not tangible. And so you've got to then go elevate yourself one higher and give the whole concept to someone. How do you breach that gap of someone coming in from a tangible world into an intangible world? How do you manage that?
Yeah, I guess there's ways to make it somewhat tangible. So what I've found over time is that people generally come to us when there's a bit of uncertainty in terms of the direction they're headed. They want to know, are we doing enough? Where is this leading? When can we retire? What could that look like? And so we do some very comprehensive projections to firstly build out the strategy, but then show over time, this is what it's looking like, this is what it turns into. And that is something that is tangible, that I find gives people a lot of peace of mind, knowing that I can actually sleep at night, knowing that I'm doing the right things, I'm doing what I have to do. There are still products that we use that are tangible as well, in the sense, when we're setting up insurance policies for people. So we've come up with the strategy, maybe there's quite a bit of debt involved, so we need to get some income protection in there, so people are actually getting that policy set up for them. As well as we manage share portfolios for people as well. And that's something that they can keep an eye on, be involved in, and that is, again, it's not tangible, it's shares, but they can log in and see something happening and be involved in it.
So I know that and because we've shared clients and you've referred a lot of clients to us, and we've referred you clients as well. When you're having that conversation with people, now you're obviously one of the rare breeds of financial planners where you say, now property as well, right? And we are very big proponents of, you got to have a holistic approach. It's just not own all property. Yeah. How does the conversation evolve when you're talking about wealth creation and wealth management?
Yeah, that's a good point. I've heard from quite a few people that they've talked to financial advisors in the past and they didn't want anything to do with property,
yep.
which is crazy. It's been such an effective wealth building asset for a long time. And so to exclude that, I feel like is missing a huge part of someone's financial journey.
Yep.
So yeah, there's definitely a focus on that. Of course, for the right person at the right time. We're not just, divvying things out.
Yep.
But a lot of it is, we'll have people come to us with big property portfolios and it's worked very well for them over time. And it might be a question now around, I'm retiring and how does this need to change or what do I need to do?
Yep.
And it always comes down to concentration risk or diversification, being exposed to, a single asset class or people can be diversified in property, absolutely. I know that's a big focus for what you do. But at some point, maybe shares do become a more
liquid asset, isn't it?
Exactly.
Yeah.
It becomes a more appropriate part of somebody's strategy. So introducing that alongside what they're doing with property. And normally people can see the benefit in that, right? As you're retiring, you want some liquidity, you want that flexibility.
Yep.
And so it doesn't take much to convince people that there's a good reason here to diversify.
Yep. And I know for a fact that you are really someone that puts the money where the mouth is, right? So you delve in shares, you delve in property as well.
Yeah.
How's the property journey been so far?
Yeah, for me personally.
Yes.
Yeah, it's been great. I've I guess got a few buckets where I'm trying to allocate funds. There's property, there's shares, and then there's the business as well. But yes, I have an investment property, and that's I've had it for sort of 3 years. I bought it on my son's second birthday, so he thinks it's his. He thinks I bought it for him.
Yeah.
But no, it's been a really good journey so far, and it's built some equity that I've been able to redeploy into other assets to, like I said, diversify and to build up other parts of my wealth.
Yeah.
And so when I'm talking to clients about property, it's very sort of front of mind for me because I'm doing it. I'm there as well. Things like rent vesting, I've been there, I've done that as well. So, being able to talk to clients about what does that look like, what does it actually mean? And then same thing with shares. I'm not telling a client to do anything that I wouldn't do or haven't done myself. Otherwise it's, there's no real value there.
Yeah, which is what I love, right? Because you're not teaching out of a textbook, you're teaching out of life experience, right? Which is very important. Because you can have, just like any profession, you can have someone that's textbook smart, but then they don't know the nuances of real life. Whereas if you've lived through that, you actually know how to handle the upheavals that's inevitable that'll come our way, right? And we were just talking off camera about the budget and how your inbox blew up pretty much overnight with people talking about the changes, right? So what's your take on if someone's on a plan and now legislation has changed, what's your take on that?
Yeah, look, there was a lot of people, I guess, wanting to sort of knee-jerk react. Because we manage share portfolios, there's quite a lot of trusts. Trusts have obviously come under a bit of pressure with the budget. But same thing with investment properties. I had clients who were, midway through the process of buying properties, and it's a case of, have we made a huge mistake now? Should we pull out? Should we not? I mean, ultimately, the fundamentals are still the same. The decisions we were making were never only about tax. Tax is always a consideration. But there's a lot more to buying an asset than tax reasons. I think what's been good about the budget is, and we said this off air, it's given people maybe a bit more reason to reflect. It felt like for a few years there, no matter what asset you were buying and where,
it just went up.
You probably made some money, right? And some assets did a lot better than others, sure, but whether it's property or shares, most people were making money in some way. This has caused people to, I think, slow down a little bit and focus more on quality as opposed to just getting something.
Quantity,
it was before it was like, I can buy whatever, I'm just in a rush, I'm going to do it before I miss out. Now it's slowed things down, actually looking truly at the fundamentals, making a decision, is this an asset that I really want to buy and why? Why am I buying it?
And we're recording this mid-July, and obviously there's all this rush of the self-managed super funds and people rushing in to buy. which is one of the things that I caution a lot of people to say, don't rush in just because the door's closing.
Yeah.
Normally when one door closes, there's 2 or 3 other doors that do open up.
Yeah.
Give it time,
Yeah.
and it does, right? So your take on self-managed super fund, should people forget the current change in lending, should people set up SMSF, and when should they set it up?
Yeah, sure. Yeah, look, there's a great case for an SMSF in a lot of cases. Obviously not appropriate for everyone.
Yes.
Normally, it really depends on the purpose of setting up the SMSF, right? So if people are coming to me and saying, I've got 3 properties and I'm out of borrowing capacity, and should I set up an SMSF, use all my super and buy a 4th property?
Yep.
Well, then maybe it's a question around, well, right now your super is kind of your only diversification piece. It's your only thing outside of property. Maybe that's not really appropriate right now. Whereas if somebody's come in and it's a whole different scenario and it makes sense to put that property within the SMSF, fantastic. But property aside, we normally like to see at least a few $100,000 in the SMSF before we set one up, or in super before we set it up. Just from a fee perspective, it starts to make sense at that point.
It does, yeah.
But then also just in terms of level of sophistication when investing, for a lot of people, an industry super fund is fine. Yeah. It's going to do the job just fine. There's responsibilities that come with an SMSF. There's risks that come with it as well. And like you, we support people through that journey to make sure everything's going well within the SMSF. But still, it's not everyone's cup of tea. So it comes down to, does it make sense from a financial perspective, but also for the individual personally, is an SMSF really the right thing?
Yeah. And I'm glad you said that, right? Because there is always this rush of, the first thing I need to flag is that no buyer's agent should be advising you to set up an SMSF. It's outside their scope. They need to put you in touch with professionals, or you need to make the decision yourself, given that if you're being guided or enticed by anyone to set up an SMSF, there needs to be a tangible reason and not just a knee-jerk reaction in terms of how and when it is set up, right? When you're talking about these SMSFs and all of the investing side of it, obviously there needs to be risk management, right? And I'm going to bring it back to property because my audience is largely property related, and I'm trying to educate everyone to go more than property. Let's say that we've got a good portfolio of properties. Now we're starting to look at risk management, which really should have been there from day one, right? What are some of the simple risk managements we can undertake?
Yeah, it all comes down to asset allocation. So looking at having buckets across different asset classes. Residential property or commercial property can obviously be a fairly big bucket because they are generally large, lumpy, high-value assets. But starting to build around it with other asset classes. So it might be things like fixed interest. So if your super at the moment is all property, well then we want to get some cash in there allocated to some fixed interest assets. So things like bonds, things like if markets fall, hopefully those bonds will provide a bit of a hedge, bit of protection. Things like infrastructure assets, which can be quite defensive as well. So everyday people can own parts of utility companies and airports and toll roads and these essential services that even if the economy slows down,
never goes away.
It never goes away. It keeps generating revenue because we all need it. We all rely on it. And then Australian shares, international shares, which yes, add some volatility, but as part of a broader risk management plan, people think of risk as losing money. Risk is just about as much about not having enough money and not building enough wealth, right? There's a risk that if you don't have enough exposure to growth assets, you're not going to be able to retire or you're going to run out of money one day. So we need to make sure there's enough growth assets in there outside of the property to give you the, I guess, longevity and growth that your portfolio needs.
Because, my view and my belief is that in the front end, you need to have the growth so that then we can then come from mid-journey to start looking at the cash flow and then looking at a firm view of what retirement income looks like, right? Whatever retirement is for you, right? And there is a lot of planning that comes along because if you're not planning, then you're being really tax inefficient in the end, where you might get to the same income but you're still giving away a lot of the income in tax and in compliance, which is one of your roles for a mature portfolio is to actually look at all of those planning to get people to the retirement income as efficiently as possible.
Yeah, absolutely. Yeah, I'm working with someone at the moment who has a $12 million property portfolio. They're in the mid-40s. It's a couple, so they've done really well. Actually, both school teachers, and they've raised a family, and they've built this portfolio. It's a great story, yeah. The net value of the portfolio is about $8 million. And they've said to me, you know, we still live like we're uni students. We're still extremely frugal. We feel like we have no money. And I'm looking at this portfolio, I'm looking at their position thinking,
why don't you have a life?
What do you mean? You know, this is a fantastic position to be in. But it comes down to just that lack of planning along the way. While they've done a terrific job, it really just has been a case of, we've got some equity, another property. We've got some equity, another property. And just put it all together. And it's got them to this point where they now think, we actually need a bit of planning here to figure out how do we transition this to something we can really live off and make the most out of. Had they done that planning along the way, it'd probably be a bit less work now to restructure and not force
less
to sell
expensive
things
as well.
and to liquidate and less expensive. So I think the planning along the way is very important.
So should someone plan, let's say someone's just starting out, they're 21, right? They've got enough for a deposit for a place. Should they start the planning at that point in time, or should they own the property and when they hit say age 25, 30, that's when the planning comes in? Which one?
Yeah, I don't think there's any, I mean, if a 21-year-old had enough money for a deposit, had some good cash flow, and they came and said to me, should I buy the investment property? Probably 95% of the time it's going to be, you know, you need the leverage.
Because you've got time as well.
Exactly, you've got time for this. So there's probably not as much value could offer there, but then they've got the property, it's built up a little bit of equity, maybe they're in a relationship or starting a family, or they've finished uni and they've got this high-paying job now, whatever it might be. Then there's a question around, okay, we need to fill in all the gaps around this and really get the plan together. And that's when we can really offer value to put all the pieces in place.
And that's why I was trying to get at is the career advancements and the lifestyles and life changes. Now, when you're starting family, when you get a big mortgage in place, when you're buying your home, all of that needs to have the protection, which is another part of the risk management, which is the insurance side of it, right? And when we talk about insurance, most people initially think it's just about life insurance, right? But there's so many different insurances and so many different ways you can pay for them, which helps create the buffer in the cash flow, but also the solid, rock solid risk management. So did you want to have a quick brief overview of insurances?
Yeah, sure. Yeah, I know insurances aren't the most exciting thing for a lot of people.
Well, my belief is insurance is something that you buy with the plan of never having to use it.
For sure. Yeah, people say all the time like, it's a little bit expensive. I don't know if I'll need it, and it's always, you know, I don't know if I need my car insurance. I've never claimed on it, but I pay it year after year because when you need it, you need it. And car is one thing. Your life and your ability to work and generate an income. If there's anything more important to cover, I'm yet to find it. So, look, it's a complicated space, insurance, and that's why advisors do assist with a lot of this sort of thing. There's advisors out there that only do insurance, but there's essentially 4 types of cover that most people would consider. There's life cover. So if you die, you get a payout, or your beneficiaries get a payout. There's total and permanent disability. So if you can never work again, probably want to be able to clear off your debt and set up your family. So that's a payout. If there's disablement, income protection. If you can't work for a period of time, maybe you're sick or injured for a year, 2 years, 3 years, part of your income replaced. And then there's one that's less discussed. It's something called trauma cover. And that's if you get diagnosed with a common illness, cancer, heart attack, stroke.
Which is very common, right?
We all know people that have had that. And so you get a lump sum in that event. You're not permanently disabled, so you don't get your TPD payout, but you get the trauma payout to get you through what's going to be a tough time. How you pay for that and set it all up. Some can be paid through super, some can't. Some's tax deductible outside of super, some's better in super. There's a whole different bunch of ways you can do it, and that's what we help people figure out.
So you help them figure out where it's best placed so that it's best use of money. and best cash flow as
Yeah,
well.
yeah. Best for the cash flow, best use from a tax perspective. Also help people identify how much cover do they actually need.
Yep.
Because as a starting point, I know I need cover, but
How
who
much?
knows how much, right?
Yeah.
So identifying,
Yeah.
we don't try to over-insure people. It's
Yeah.
really a case of,
Yeah.
if the worst was to happen, what do you need just to make sure everything's okay?
Yep. All the
set that
mortgages
up.
are taken care of, all of those things.
Exactly.
And
If you're
life
trying to put your
expenses.
kids through
Yep.
school or something, let's make sure they can still go through school.
Yeah.
Like all of those sorts of things.
Yeah. So it's really important then to then map out what life looks like for the next couple of years, or at least the next decade, to then arrive at a figure on this end, given the assets and the liabilities you have, right? Whereas most people go down the knee-jerk reaction of, okay, I want to have life cover, I have $1 million of life cover, right? But it's not really thought out, because it needs to be a specific figure based on their circumstances, their financial capability.
Yeah.
Pretty much the same as property, right? Anyone can buy a property and most people just go out and buy, but it needs to be within their capability of negative cash flow, their capability of how much deposits they've got, so therefore loan qualification, and just as importantly, what age bracket they are, and what type of asset then they should buy, right? So if we bring that back into insurances, which the minute you say insurance, people, like you said, they just keel over and die, which is what you're trying to pay for. Years ago, when I started investing, I had one of my mentors actually made a really simple calculation for me, right? And he said, "Oh, you're insuring your car, right? And the car's worth at that time it was $30,000, maybe not even that." And he then also asked me to map out what he said the car's lifespan would be 5 years, right? And let's talk about 5 years worth of your income projection. He said you're insuring a depreciating asset, right? Whereas your income potential is going to go up. Why aren't you insuring that, right? And that switched my thinking on that, because before that it was like, hang on, I'm going to come up with $1,000 to pay for my insurances. Now, obviously, it's much more expensive now, right? We're talking circa 30 years ago, right? But that's a mindset shift when you start looking at perspective. Like you said, you can, without thinking, you pay for your car insurances. But you're actually having a hiccup when you're trying to pay for something that's far more valuable.
Oh, you could cover a $30,000 car, or you can cover the next 20 years of your income. And even if you're earning $100,000 over 20 years, there's a huge amount of money that's going to be lost if you're unable to work. So it's a very important thing to cover. I guess, like, coming back to your point around, like, we're trying to get into somebody's world now, but also look at the future, look at what's coming, how that's going to change over time, and build a plan that's appropriate for that, not just for insurance, but all round. It's a very hard thing to do because life changes so much. And I know I get to the end of every year and I think, like, whoa, how did that happen this year? So much changed. And that's where, like, it's very infrequent that we work with someone on a one-off basis. It's always an ongoing thing because life is constantly changing. Your insurance needs change every year. In many cases, your insurance needs go down year by year because you're building assets and wealth in other places that are going to protect you, or maybe your debt's reducing over time, or depends what sort of stage of life you're in. But just generally, with all the advice that we give, a plan today sounds great today, but in 2 or 3 years, it might not be relevant anymore.
But it's not linear, right?
Exactly right, So always having to adjust and work with people over the long term to, I guess, going back to what I said before, oversee the broader plan and make sure it adjusts with somebody's life.
And so that's why you need to be looking at it across all facets, right? So do you then, and this is going to be a controversial question, do you then lock horns with accountants or buyer's agents in terms of, okay, now that's not the path you should go down?
Look, it's when somebody has an existing relationship with, say, an accountant, and that accountant has been providing some degree of advice. Some accountants seem to give, some advice, some stay out of it completely. If they've been providing some advice, I'm not there to step on toes, and I'm trying to respect that relationship, but also trying to offer
alternatives.
And some feedback and my opinion on things. A really common one is an accountant, what they care about first and foremost is tax, right? So, you've got some money, you're 32, why don't you do a $30,000 concessional contribution, or it'll save you this much tax? Okay, the person goes and does that. But considering that 32-year-old can't touch that money for probably 28 years, that's a big commitment to make, to put away $30,000 for 28 years when you might be raising a family or trying to build assets to retire early. Or so trying to, I guess, educate and offer an alternative to people that hopefully they my goal is always to make sure people are very well informed before they make any decision and know their options. And so that's what I'm here to do.
So this is what I was trying to elicit, right? So when you're looking at professionals, accountants, buyers agents, mortgage brokers, you need to look at the bias, right? And their expertise. And so therefore they will talk to death about their expertise, and that's the right way, right? Because that's their sphere, right? And where you come in is to say, okay, I'm going to look across all of these experts and provide a combined solution that then they go back down to the accountant, to the broker, to the buyer's agent to implement, right? And sometimes it comes reversed, right? So like when we send you clients, right? It's we've got them to a stage, like we talk about the teacher, right? We get them to that stage, and now there needs to be better and more diversification and better allocation of assets. And now we need to start thinking of what does it look like in retirement. And so that's where you come in as a financial planner to actually essentially become the puppet master is what I'm looking at it, right? So
and I mean I don't want it to come across as arrogant or sound that I'm just directing everyone this and that. I fully respect everybody's got their expertise, and you're far better at anything property related than I am, and an accountant's far better at anything tax related than I am. But it's really just trying to make sure whatever the outcome is for the client is truly in their best interest, and hopefully having a deep enough relationship with them to be able to see, okay, if this particular professional is recommending this thing, well, how does it fit in with what we're doing here? Because that professional doesn't know what we're doing here. So they might think that this is the right thing for you, but they just don't realize that we're doing this alongside as well, and it's conflicting, and so we need to make a decision around that. So it is kind of piecing everything together while really relying on and respecting on everybody's role in that relationship.
So true wealth management, right? In that sense, right? Without doing the nitty gritty of it, you're looking at it from a high level, and then setting the process in motion, and then they come down to the different disciplines to get the implementation happening. And also just as important, and this is one of the things that I want to talk about, is estate planning, right? So obviously people build a portfolio. How does it transition into retirement? And just as importantly, how does it transition into the next generation?
So I guess the first bit, how does it transition into retirement? It's really about looking at liquidity needs, income needs. Can the properties provide that for someone? Or is there a need for a liquidation event, whether that's to clear off some debt and ease some cash flow? And that in itself might, leave you with enough passive income through retirement. Or is it a need for liquidating a property to diversify and to get into other assets? When we're in retirement, I mean, the key structure we're looking at is superannuation. It's easily the most tax effective and best for long term. Also for estate planning purposes, super can be very effective for transitioning assets and wealth to the next generation. Assets outside of super, when it comes to the estate planning side of things, we're looking at trusts, looking at things like testamentary trust, actually talking to the families as well to make sure they're on board with the strategy and that there's these things can get quite complicated. So having the kids involved or whoever it is, knowing that, okay, when this happens, when the time comes, things could land in this bucket and is that the right place? How's it going to be split amongst the beneficiaries? But ultimately, a solicitor then has to be involved. They're one of those professionals that actually then has to draft the wills, set up these structures and get it all happening.
But you have the planning of it, and then it goes down to the specialist.
Exactly right.
So one of the things that's the least understood is obviously superannuation.
Yeah.
Right. And from my limited knowledge, you can start deriving income from super, from age 60 onwards.
Yeah.
Right.
Yeah.
And when you really look at it, right, so you've got a share portfolio happening, you've got a property portfolio happening, and then you hit the age of 60, you can start deriving, a percentage of the valuation value of it annually. It is fairly easy to get to retirement income when you really look at it, right? So long as you had the planning along the way. Yeah. What do you think people do wrong mostly in terms of planning their super fund?
Yeah, I think it's having that number in mind, 60 or 65, and that's when I'm going to retire.
Yep.
So that's when I need to think about super.
Yes.
You need to think about super
Right from day one, isn't it?
Yeah, long before that.
Yeah.
Look, super for someone in their 20s is important, but most 20-year-olds don't feel like it's important because it's years away. It's 30, 40 years away. Yep. I always tell people in that position that, say I'm talking to Victor and he's 25, and I tell them 25-year-old Victor doesn't care about his super.
I'll take that, yeah, 25.
But 60-year-old Victor will care a lot about his super. It'll be one of his most important assets, and he'll be very thankful to 25-year-old Victor for looking after his super and doing the right thing by it. Now, it doesn't mean you have to be putting extra contributions in your 20s or even 30s, right? Because there's still a lot of life to live, a lot of expenses to get through, and putting money in super locks it away.
Yep.
But generally, by your late 40s, early 50s, you really need to start thinking about what assets have I built outside of super, and how can I transition some of that into super?
Yep.
Because once you hit 60, super can become a very tax-effective place, tax-free up to a certain limit.
Yep.
And the more assets you can have within those limits, the better off you're going to be longer term from a tax perspective. In retirement, you probably want to be keeping as much of your money as you can rather than paying tax. And so if we can really plan around super and getting assets into there before it's too late, then that's going to set you up for the best retirement.
When is it too late?
It's never really too late, but from a super perspective, non-concessional contributions, which are how you can get big amounts into super, they cut off at about age 75.
Right.
So 28 days after your 75th birthday. So if you're not doing something by age 70, it's probably too late to get large amounts into super. But then you think if you're 70 and you're only thinking about it then, you've had 10 years of paying tax on assets where you probably could have had it tax-free.
Yes.
So really, by sometime in your 50s, you really want to be thinking about it.
And people, with this planning and this transition, people balk at the cost, the upfront cost of it, right? So as an example, you could be selling down a property and putting the funds into the super fund, right? Which has got a capital gains tax implication, which has got the selling costs and so forth, right? But it's all about actually getting, like you said, getting to the number as to what the income is you're after. And then looking at all of the moving parts and saying, okay, this sits in this bucket, this goes and sits in this bucket. So that you still got assets, but you've also got liquidity and cash flow coming in retirement, which is what most people don't plan for, right? Everyone's good at building up the assets, but when it comes to letting go of the assets to transition, that's when we hit the hurdle.
For sure. Nobody likes to sell things.
No. And so how do you handle that?
It's just showing the value in it. It really is like that couple that I was talking about before, going back to them, $8 million in net property assets. And of course they don't want to sell everything. Like they've been holding those properties for a long time. They've put a lot of time and energy into that. By showing them, I guess, two alternative worlds. You can keep doing what you're doing and you'll be forced to work until you're 60-something, at which point you might be able to have a modest retirement, or you can start restructuring now, which is going to require selling some assets, clearing off some of that debt. But look, we're going to keep these assets here. These are the ones that are doing well. These are the ones that you like. These might be the ones you're attached to or make sense to keep. But with the rest, this is what we're going to do, and this is what it's going to mean for your income, and therefore what it's going to mean for your life and your flexibility. And I think once you actually show people that, it's pretty compelling. And most people can see, there's actually a retirement to be had here, life to be enjoyed, and the decision to sell isn't so hard anymore.
And I'm thinking the small voice here is going right when you're talking, right? And I know all of these things, right? And I've got those plans in place. But the way you put it in terms of, okay, once the path is shown, it's fairly easy. I'm thinking, okay, maybe I got to come and sit down for a cup of coffee, right? So,
anytime.
And so if someone's thinking in this space, especially beginning of the financial year, what's the logical next step?
Yeah, so if you're thinking about getting financial planning, look, we do free initial meetings, short meetings, just to make sure we're a fit and we can actually help.
Yep.
I try to be as honest as I can, and in some cases that conversation goes, oh look, just think about this and this for the next couple of years, and then let's sit down and do this properly.
Yep.
I want people to get as much value out of it, and the timing has to be right.
Yeah.
But in a lot of cases, that conversation, we do find that there's a need for financial planning. There is a fit there.
Yep.
And so we go into a discovery meeting, which is a long get to know you properly meeting, your finances and you.
So that's when they actually pay for your services. So the initial conversation is obligation free. Yep. And then they when you're actually sitting down at length, and that's when they need to start paying for the service, right?
Yeah. There's a small fee of just a few $100s for the discovery meeting, just to cover that time, but it's still obligation free. Yep. So you do the discovery meeting. I appreciate that. Coming back to what we were saying, the financial advisor is overseeing everything. It's someone you need to have a good relationship with.
Yep.
And so I want people, as much as I need to get to know them to give them good advice, I fully acknowledge that they need to get to know me and decide if they even like me and want to work with me before they make that commitment. So that discovery meeting is obligation free as well. If they then decide after that meeting that they want to get advice, that's where we compile further information. I spend lots of time putting together the strategy. We'll have a strategy meeting to run through it, get feedback, make sure it's all appropriate. Yep. And then it lands in a big document called a statement of advice, which, yes, because of all that regulation, all that red tape that we talked about before, there's a lot of disclaimers in there. Yep. But we do try to make it very personal. I mean, it reads as though it's written specifically for the individual reading it. It can, I've done sort of 80-page statements of advice. They can be very comprehensive, a lot of information. And then, we carry on with meetings to get it implemented and get the plan up and running and come to life. And then we can work with people on an ongoing basis if they want to opt into that. Yep. Some people would rather just keep it kind of ad hoc. I know some people don't love subscriptions and being locked into things, and that's completely fine. Yep. We have fee-for-service models where when people need us, we're there. When they don't, then that's up to them.
Yeah, and it's important to be checking in with the financial planners, your accountants, your brokers on an annual basis, right?
Absolutely,
because then you're giving the wheel a pat every now and then to keep it rolling. Otherwise, it stagnates, and then that's when you actually do lose money.
Yeah, definitely. As you said, life changes a lot year to year, so you've got to keep it updated.
Yeah. So any parting words of wisdom for our audience?
Any parting words of wisdom? Oh, I didn't prepare for this. I think there's probably two quotes that I when I'm investing for anyone, as I said, we manage share portfolios. So when I'm investing or when I'm just putting a plan together for anyone, two quotes that I try to keep in mind, and they're both from the great investor Warren Buffett, which is a bit cliche, apologies, but the first one is, and it's not word for word, but it says somebody today is sitting in the shade because somebody planted a tree a long time ago. Okay, so it really comes down to the things that we do today. We want to make decisions that are going to benefit us later on and also benefit others later on. But it all comes down to action today. And it comes down to thinking long term. A tree doesn't grow overnight. So long term, what are we doing today to benefit our futures? The second one is only buy an asset if you would be okay buying it knowing that the market's going to be closed for the next 10 years. In other words, it all comes down to really think about what you're doing, why you're doing it, and what is the quality of the asset. Am I just jumping in on this because I'm trying to make some quick wins? Am I jumping in because everyone else is doing it? Or am I making decisions
based on your financials, right?
Exactly right. Because it's right for me, it fits into my plan, and because it's a good quality asset. So I think those are the two things I always try to keep in mind. Just thinking long term and making clear, informed decisions today.
Fantastic words of wisdom. Matt, thank you very much for sharing your knowledge, and we'll put your contact details in the notes.
Sounds great.
Yep. And so this has been Property Investing Insights Client Stories, and over the next 12 months we will be introducing a whole lot of strategic partners that in your journey of building up a portfolio, looking at it from a wealth management point of view. If you have any questions, of course, questions at rightpropertygroup.com.au. Don't keep us a stranger. Share us with your friends. Hit that share button, and I'll see you again next time.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.